Knowledge, power, and management. At the end of the 19th century and the beginning of the 20th, these three concepts converged in a single name, J.P. Morgan. He was not only the owner of a vast fortune, he monitored the pulse of America's most profitable sectors and made decisions that shaped the country's economy at critical moments. Sometimes a single signature was enough to keep a failing company afloat. At other times, a decision he made spelled the end for massive corporations. For some, he was the dark side of power. For others, he was the last bastion maintaining order. Yet there was one truth everyone agreed on. J.P. Morgan was a figure ahead of his time. This is the story of the man who shaped the backstage of modern America. John Pierpont Morgan was born in 1837 in Connecticut, into a wealthy family at the very center of the financial world. His father, Junior Spencer Morgan, was a respected international banker, with strong connections on both sides of the Atlantic. It was clear from the beginning that John's future would lie in finance. Therefore, his education was not random, but deliberate, planned, and designed as a long-term investment. He attended the best schools of the era, had private tutors, and adopted a Europe-centered perspective from a young age. Yet behind this privileged start was a difficult childhood. Morgan was a child often separated from his peers due to frequent illnesses. He spent his time with books and numbers rather than games, and this early isolation laid the foundation for the mental discipline that would define him. As his health problems grew, his father sent him alone to the Azores. The year spent away from his family instilled patience and resilience in Morgan. The calmness he would later show in crises was forged during this period. By 1857, at the age of 19, Morgan had completed his education in Boston and had closely studied the European financial systems in Switzerland and Germany. Thanks to his father's partnership in George Pody, he began working on the famous Wall Street and reported American political and financial developments to London. Despite his young age, he analyzed not only data, but also market psychology and political risk. However, his father worried about his impulsive nature and willingness to take risks. This concern materialized in 1859 when Morgan in New Orleans purchased an unsold shipment of Brazilian coffee with company funds. Although he made a profit, this move was recorded as the first major clash between secure banking and aggressive finance. In 1861, at the age of 24, he decided to chart his own path. He left the safety of a bank to start his own firm. That same year, he married Amelia Sturgis and briefly found happiness in his life. However, this joy was short-lived. Amelia contracted tuberculosis and died just 4 months after their wedding. This loss created a deep and lasting rupture in Morgan's life. Throwing himself entirely into work, he navigated a nation in the midst of civil war. Despite the 1863 draft law, he paid $300 to send a substitute soldier in his place. He did not fight on the front lines but profited greatly from the war economy. During that period, he purchased 5,000 old muskets, considered scrap by the government, for $3.50 each. After minor adjustments, he resold them for $22 apiece. Earning over 600% profit, this deal brought Morgan wealth but also public backlash. It was the first indication of the controversies that would follow him throughout his career. By 1871, John Pierpont Morgan was no longer just a promising banker. He had become a figure whose influence was felt throughout financial circles. That year, he partnered with one of the era's most respected financiers, Anthony Drexel, to establish Drexel Morgan. The firm quickly became a financial hub on both sides of the Atlantic. Years later, this structure would form the direct foundation of today's J.P. Morgan Chase empire. At this stage, Morgan was less a conventional banker and more a strategic intermediary. He connected major European capital owners with American entrepreneurs who had vision but lacked access to finance, profiting handsomely from these relationships. However, eventually acting merely as an intermediary was not enough. He wanted to take risks, deploy capital directly, and become a decision-maker. This pursuit led him to one of the era's most critical sectors, the American railroads. In the last quarter of the century, the American landscape was striking. Andrew Carnegie dominated steel, John D. Rockefeller controlled oil, yet railroads were chaotic. Many companies operating on the same lines engaged in price wars to survive, pushing the industry toward instability. Morgan saw this disorder not as a crisis, but as a huge opportunity. He believed the solution was not harsher competition, but consolidation and centralization. He acquired financially weak railroad companies, reorganized their debts, and unified them under a single structure. But Morgan did not stop there. He demanded full authority in the management of the reorganized companies. He appointed top executives and personally shaped long-term strategies. This approach was so systematic that it introduced a concept in financial literature bearing his name, Morganization. This method involved reviving indebted companies through strict management, strong financing, and centralized control. The results appeared quickly. Companies became profitable, and stability returned to the sector. European investors began to view Morgan-controlled railroads as safe havens. As large amounts of capital flowed into America, Morgan's wealth and influence grew rapidly. At one point, about one-third of American railroads were under his direct or indirect control. Considering that railroad companies made up roughly 60% of the American stock market at the time, the magnitude of Morgan's influence becomes clearer. Morgan's presence was also striking physically. His facial features, sharpened by rosacea and rhinophyma, combined with a stern gaze and authoritative demeanor, made him a dominant figure in any room. For many executives and politicians, standing against Morgan was a daunting challenge. Yet his power was tested in 1901. President Theodore Roosevelt sued the Northern Securities Company, established under Morgan under the Sherman Act, claiming it eliminated competition in the railroad sector. The company was broken up, marking a significant blow to Morgan. Yet this setback revealed a larger truth. Economic power had political limits, and Morgan had begun envisioning an even greater move that would affect the entire American economy beyond railroads. By 1901, America's industrial balances had become clear. Steel was the essential raw material of the modern world, and Andrew Carnegie was its absolute leader. Carnegie's steel operations earned about $40 million annually and played a decisive role in every sector, from infrastructure to skyscrapers. But Carnegie wanted to retire and devote his fortune to philanthropy. At the time, the only person capable of purchasing such a company was John Pierpont Morgan. When Morgan asked for Carnegie's price, Carnegie said $480 million. Morgan accepted without negotiation. This sale was unprecedented in size, but it was not the end. It was the beginning of a much larger plan. Morgan combined Carnegie's company with other major producers to form United States Steel. With a value of $1.4 billion, United States Steel became the world's first billion-dollar corporation. This amount equaled nearly the total value of all American manufacturing at the time. It was a significant structure, giving Morgan control over roughly two-thirds of American steel production. Thus, he became a decisive force in two critical sectors of the era: railroads and steel. For Morgan, this was not just wealth. It meant price stability, predictable costs, and a secure foundation for major infrastructure projects. His influence extended beyond industry. He financed Thomas Edison's electrical work, helping consolidate Edison's ventures into the creation of General Electric. Similarly, he played a central role in shaping the American communications infrastructure, which would later become AT&T. Morgan's management style was consistent: consolidate fragmented competition into a strong entity, creating scale and stability. In 1893, the United States faced one of its most severe economic depressions. A decade of rapid growth, excessive debt, and uncontrolled investments finally exploded. Stocks lost nearly half their value. Thousands of companies closed, hundreds of banks failed, and unemployment skyrocketed nationwide. The crisis was not confined to the U.S. Foreign investors, selling American bonds, began demanding gold. At the time, the dollar was tied to the gold standard, meaning paper money had to be backed by physical gold. The government needed at least $100 million in gold reserves. By 1895, reserves were nearly depleted. At the critical moment, only about $9 million in gold remained in the Treasury. This created the risk that the government could default on its debts. The United States had no central bank, and no institutional mechanism existed to manage the crisis. President Grover Cleveland understood this was a turning point that would determine the country's future. Conventional methods, such as issuing new bonds, could not buy enough time. This is where Morgan stepped in. He traveled to Washington, met the president, and presented an unconventional plan. Morgan proposed forming a private consortium of the country's strongest bankers. By involving European capital, he would rapidly strengthen America's gold reserves. His offer provides $65 million in gold in exchange for 30-year gold bonds. Thanks to an old Civil War law, President Cleveland could approve the deal without Congress. After signing, Morgan telegraphed his team in New York. Legend has it, the bonds were sold out in 22 minutes. Markets calmed almost instantly. Trust was restored. Panic ceased. America avoided default. Morgan not only quelled the crisis, but also profited greatly from acquiring gold bonds at favorable terms. This stirred public concern. How could the fate of a nation rest in the hands of a single banker? Yet the reality remained unchanged. At that moment, J.P. Morgan was the man who kept America afloat. A similar scenario unfolded in 1907. Bank runs began. People queued to withdraw their money. The government instructed tellers to count deliberately slowly to delay cash withdrawals. The crisis was spiraling out of control. Theodore Roosevelt was president, and his relationship with Morgan was not good. Yet the situation was so severe that ideological differences were set aside. Roosevelt asked Morgan to intervene. Morgan gathered the nation's leading bankers in his New York library. He decided which banks would receive the necessary capital and did not end the meeting until a consensus was reached. Ultimately, both private banks and the Treasury injected millions of dollars into the system. Confidence was restored, and the banking system was saved. Morgan was 70 years old and seriously ill at the time, yet he once again rescued the American economy from disaster. These rescue operations did not diminish Morgan's power. They made it more visible. The public began asking, why did a country's economy constantly rely on a single private financier? This scrutiny became formalized through the Pujo Committee investigations. The committee examined the true power of money trusts on Wall Street, and Morgan had become their symbol. In congressional hearings, he appeared as the central figure of the American financial system. The process took a psychological toll on him. He suffered nervous breakdowns and his health deteriorated. Interestingly, he was initially planned to be on the Titanic's maiden voyage, but at the last moment, health issues forced him to cancel the trip. The Pujo Committee's findings clearly showed the need for a permanent solution. Individuals could no longer be relied upon in times of crisis. This awareness paved the way for the creation of the Federal Reserve, the U.S. central banking system, a few years later. Morgan passed away in Rome on March 31, 1913, without seeing this transformation's results. After his death, his son took over the reins. J.P. Morgan continued to grow through mergers and acquisitions for decades. In 2000, it merged with Chase Bank, forming J.P. Morgan Chase. Today, with nearly $3 trillion in assets, it stands as one of the world's largest banks. John Pierpont Morgan is remembered as a controversial figure. Some see him as a greedy monopolist, others as one of the architects of modern America. But one fact is undeniable. From railroads to steel, banking to electricity, Morgan's influence shaped America's economic infrastructure. His legacy still lives at the heart of the global financial system.